Hi everyone, this is the video of lecture 2 which we did in week 2 and I'm recording this as a video just in case you did not understand the topic and you wanted to view or revise the topic again. Remember, lecture 2 talks about two things. One is how we use the accounting equation to actually record business transactions, and secondly, how that accounting equation is then extended to the double entry system of accounting. So let's start by looking at the definition of accounting. If you recall, accounting is a process of identifying, measuring, recording, and communicating economic information to users so that they may make decisions based on informed judgments provided by this information. And how do we reflect and provide that information is through what we call the accounting equation. And remember, the accounting equation is represented by assets on one side of the equation and owner's equity and liability on the other side. And remember, I said assets represents resource. It represents resource that the business can use in the business to generate wealth, to generate profits, to generate money. So those are represented by assets. Or the owner's equity and liability represents claims on these resources. These claims arises because these resources come from these parties, either from the owner themselves or from people other than the owner, which we refer to the liability. Now, we can rearrange this accounting equation by moving the liability over to the asset side, which makes it a minus. So assets less liability is represented by the net owner's claim on these assets. This also shows the owner's wealth on this asset, the owner's net wealth, because whatever resources, whatever assets that the business have must be first used to pay off other claims other than the owner's. Whatever is left would be the owner's wealth. So that's another interpretation of the accounting equation. Now, this assets equals to owner's equity and liability, resource equals to the claims on this resource, is often presented in the statement of financial position because it represents the financial position of that business. The old name for this statement is the balance sheet. Why is it called a balance sheet? Is because your assets must always equal to the owner's equity plus the liability. So that's often represented by the statement of financial position. This is an example of the statement of financial position of a business called Acme Auto Repairs. The statement of financial position is always reported as at a particular date. It's like a snapshot. You take a camera and you take a picture as at a particular date. And what do you see? Well, on the left-hand side, you see all the resources that is available to Acme Auto Repairs. These are cash, accounts receivable, which are claims on cash. It's still good enough as a resource for you. Supplies that Acme Auto needs in repairing the cars that it has, or equipments that it needs to use to repair the cars. The land that the workshop resides in and the building that the workshop resides in, they are all resources that Acme Auto Repairs can use. Who claims these resources? Who provided these resources? Then on the right hand side you have the liabilities. These are accounts payable, people you buy products from, supplies from, and you haven't paid them, so they claim amounts from you. Mortgage payable is basically a loan on your land and building. So the total amount of liability is 73,920. And then the balance will be the owner's claims. The owner is Martin Brady, and the owner's net claims is 95,560. And these two are claiming the total assets of 169,480. So this is why the accounting equation must always balance. Whatever assets that you have must be the sum of all the claims on those assets. So this is the basic principle of the accounting equation. Now we went through some definitions of what an asset is. I won't go into it again. Asset is resources. It can be tangible, things that you can see. Intangible ones are those that you can't. You're going to study that more in your further studies in accounting. Resources can be owned, but doesn't always have to be owned as long as it's been controlled in some way. And it is expected to generate future economic benefits. In other words, it's expected to generate cash because the ultimate future economic benefit is cash. Liabilities are legal and sometimes other types of obligations other than legal ones to actually settle cash or to someone else, to third party. Okay, and this is represented by a third party's claim on the resources of your business. And the owner's equity is the residual claim, whatever is left of your assets after the third party liability has a claim on those assets. So these are the definition of elements in the accounting equation. We also talked about the accounting entity assumption, which says that the business, we always deem the business as a separate entity, different from its owners and also from other entities. So when you look at accounting for your entity, in this case, let's say is entity A, you must always treat other parties, including your owners, as separate parties and treat them as external parties accordingly. We'll demonstrate that in later how this is done. The other important principle that we need to adopt when we are recording accounting transaction is this principle of duality, which is derived from the accounting equation. The accounting equation on the left hand of the equal sign must equal to the sum of the two items on the right hand side of the equal sign. So mathematically, if you want that to be equal, if you add an item of asset, then you must either add an item of equity so that it is balanced, or you add an item of liability to make it balanced. So each transaction must have two effects on the three elements of or any of the three elements of the accounting equation. If you want to increase your asset, but there's no impact on owner's equity and liability, then you must have decreased another asset so that the accounting equation balance. So again, a transaction must have at least two effects. It can be in the same element. And if you increase your equity, you can also you need to decrease your liability if there's no effect on the assets. Okay, so that again the accounting equation is balanced. So the rule is that every transaction must have at least two or more effects on the accounting equation. So we went on to look at an example and to demonstrate how this accounting process, taking into account duality, taking into account the entity assumption, understanding the accounting equation, how do we actually record business transaction. So we said we are looking at Sam, who is a cleaner, and we want to record Sam's transaction for a few days and its impact on the accounting equation. And remember, the accounting equation is assets equals to equity plus liability. So the transactions are as follows. which we have gone through in class. And what we want to do is to record its impact on the accounting equation. Now, when we do that, we actually have to subclassify or further classify the assets into separate items because there may be different types of assets. So in this example, there is assets called cash, there is asset called equipment, there is asset called supplies, and receivable. The equity will largely be made up of capital, and we have a liability called a payable. All right, so what we want to do now is for each of the 10 transactions on the left, we want to analyze its impact on the accounting equation. The first one is Sam started the business by opening the bank account with $30,000. He brings in $30,000 into the business. So if you take the entity assumption and look at it from the point of view of the business has an increase in cash of $30,000. Who claims the cash? Is the owner. We treat the owner separately as well. So we will recognize that the owner's claim on the asset has increased by $30,000. So again, duality principle has been complied with. That one transaction has got two effects on the accounting equation. Second transaction is Sam used the cash to actually buy equipment. So when he buys the equipment, he would increase the equipment. He didn't have any equipment earlier. Now he has $14,000 worth of equipment. What did he use to buy the equipment? He used up $14,000 of the cash. So the cash would have reduced by $14,000. There's no other effect on capital. The capital, if you add them together, you have $16,000 cash, $14,000 equipment. The capital remains. The owner's claim remains the same. So again, the duality principle has been complied with. That second transaction has two effects on the accounting equation. The third item there, third transaction, is that Sam bought with cash, in this case on credit, bought supplies of $4,500. So the supplies would have increased by $4,500. Supplies are assets. You can use them to generate profits in the future. But he hasn't paid in, so he got no effect on cash. If he has not paid the amount, then someone is claiming it. Who is claiming it? It's not Sam, the owner, but the third party, the supplier. And we classify that as a payable. So the payables claim now has risen by $4,500. So this is again met the duality principle. Two effects based on one transaction. The fourth transaction is that Sam went to a customer's place, cleaned the toilets or cleaned the house, and he received cash in consideration for that service. So cash would have come in, and Sam would have recorded down an increase in cash of $1,200. Now the question now is who claims the cash? It's not any third party. The customer paid you because he's happy with what you've done. So that money now belongs to Sam, the owner. So Sam can claim it because this is the wealth that is generated by the business for Sam. But this wealth is as a result of your business transaction. So while it increases its capital, we need to identify it as a particular type of capital. This type of capital is a revenue capital. This is revenue generated from the service, capital generated from the service, equity generated from the service. The next item is where Sam went and did some cleaning, but the customer has not paid Sam. So if the customer had not paid, no cash came in, but you can recognize a claim on that cash from the customer, and that's also your resource. When you have a claim on someone else's cash, that's also a resource to you. But this resource what does it represent? Who claims it? Is it Sam or a third party? Well, no third party claims it, because this is again the work that you do. So again, this is considered to be revenue, because this is part of your service that you're providing, and this is claimed by the owner, Sam. Then if you look at item number 6, Sam, when he went to do the cleaning job, he actually had some workers with him, and he had to pay wages for the workers to help him with the job of cleaning the home or the toilets. So this wages is now has to be paid. So when you pay these wages, you pay it in cash, so your cash is reduced. But what does this wages represent? This wages represents the consumption of this cash to generate your revenue. So your wealth has decreased because you had to pay someone to work for you. So it has got an impact in equity by reducing equity. But again, this is part of your business activity, so we call it an expense. When you consume your resources to generate your revenue, it's called an expense, which actually reduces your equity. And then the item number 7. Remember, in item number 3, you had bought supplies worth 4,005. That's something that you can use. But on the 7th, when you check your supplies, you realize that you only had $3,700 worth of supplies left. So there must be some that is missing. How much is missing? It's $800 missing. So that has resulted in a decrease in the supplies by 800. Where did that go? Well, we have to assume that that amount has been used up in your cleaning service, because these are what the supplies are for. So it's been used up for the cleaning service, you would have reduced your wealth as well. So Sam's claim would have been reduced. But these are amounts, resources used in generating your revenue. So we have to actually classify them as expenses. But it's a reduction in equity. And then your transaction number 8. Transaction number 8 involves collecting amounts from your receivable. Did you remember your receivables there? So when you collect the amount, you reduce the receivable, but you will have collected cash and your cash would have gone up. Right? This doesn't change the amount of resources, it only changed the form from a receivable to cash. Again, the duality principle has been met because there is 2 effects on the accounting equation. Transaction number 9 involves Sam paying off his payables. So he would have reduced his cash by 4,005 to pay off and reduce his payable of 4,005. So again, 1 transaction, 2 effects. Finally, transaction number 10, Sam withdrew $200 for his personal use. So his cash would have been depleted by $200. And this represents the amount taken out by Sam, which basically means that he would have reduced his wealth in the business by taking out money. So he would have again minus off his capital. And we have to identify it as a drawing, because this is not expense. This is not the business expense. This is Sam taking out the money for his own use. Again, this reflects the entity assumption. We don't want to treat Sam's personal expenditure as part of the business expenditure. So this is how we record transactions, accounting transactions, and how it affects the accounting equation. So at the end of that particular period, what we do is we then add all the relevant columns in the accounting equation. We find the balances. So if we add up all the plus and minus in the cash column, we will arrive at a total cash of 12,600, a net cash of 12,600. The equipment remains at 14,000. So supplies on hand is 3,007. There's no more receivables. So the total resources here of the assets should now represent whatever equity. Now, if you add up that column, you'll get 30,300. There is no more payable. So we can now extract the statement of financial position as at that final date and present it now in our financial statement. So the top part of this diagram shows the statement of financial position. It shows the three assets that Sam has, and it shows that this is now all claimed by Sam. So Sam's wealth is represented by all the assets because there is no liability. Now, it is now time that I introduce you to a second statement. This is the statement called the income statement. And in this income statement, we record down all the revenues and expenses that is generated for that particular period for that business. So if you recall, the total revenue earned by Sam when he made the two services was 1,750, and the two expenses were the supplies that had been used and the paying of the wages to his employee. So as a result, if the revenue exceeds expenses, Sam would have made a profit of 500 in this case. But if revenues are less than expenses, then he would have made a loss. And then the third statement shows the changes in the wealth of Sam. And this will show the capital at the beginning when he introduced it was 30,000. He made a profit of 500, which is reported in the income statement. He withdrew 200, so his net wealth at the end of the day is 30,300. So this is one of the reports. This is the sample of some of the reports that can be generated just by analyzing transactions according to the accounting equation. So now finish this off with looking at further definitions. The definition of revenues. Revenues are the inflow of economic benefit, in this case cash or claims to cash, that arises from the performance of service and the sale of goods, your business. And expenses are what you consume, what are the resources that you consume to actually generate the service or provide the sale. So these are the two definitions of revenues and expenses. Now there's also a need to also define two other things. One is capital expenditure versus revenue expenditure. Capital expenditure means that you have spent money on something. You have paid something. You have paid for something. So when you pay for something, when you incur expenditure to create resources that can be used over a number of periods, we call it a capital expenditure, and you generate an asset. So if you pay money to buy supplies, and the supplies can be used in the future, then the supplies represent an asset. What you have paid to buy represent an asset. But if you have incurred expenditure to generate revenue immediately in the same period, so let's say you pay wages for people who have already worked for you to help you generate the profit, to help you generate the revenue, that expenditure is called a revenue expenditure, and that amount is treated as an expense. So this is important because you need to understand the difference between an asset and an expense. An asset is a capital expenditure that allows you to generate revenue in the future. An expense is something that you've consumed the same period to generate your revenue. There's no other revenue that you can generate in the future, and that's why it's called a revenue expenditure. So now we can expand the accounting equation that we started out with, because the owner's equity can be broken up now into four components. Capital, which increases owner's equity, and drawings, which actually reduces owner's equity. Revenue increases owner's equity, but expenses reduces owner's equity. So that's now a more sophisticated look at the accounting equation. So this is the first part of this video that uses some example to illustrate how we use the accounting equation. And the accounting equation is the fundamental building block that we use to record business transactions. The next video, part 2 of this video, will then extend the accounting equation to the concept of the double entry system, which looks at debits and credits. So I'll see you in that second part later to explain the double entry system.